Hey, welcome to the Mortgage Minute for Wednesday, August 31st, end of the summer. My kid's going back and playing hockey already. Now, here we're getting back into the Mortgage Minute. You're going to start seeing this on a regular weekly basis. News from the week, Wall Street Journal from Monday. IMF chief says she's worried about global fragility. And really, it's interesting. Policymakers aren't adequately addressing problems. In other words, the concern over the Greece and all the European stuff is not going away. Watch for this. My prediction is we're going to start seeing some things blow up around November. That's my prediction. In the meantime, due to European and global issues, the economy is shifting under Mark Carney's feet. This is suggesting that Mark Carney not only will not raise rates in September. It's funny, a client just phoned me and said the bank said the rates are going to go up in September. No, they're not. The variable prime interest rate is not moving in September. In fact, it's even suggesting that some economists are calling for Mark Carney to drop rates a little. He has a little wiggle room. He can do that. What's interesting is I actually had the opportunity to meet a Bank of Canada employee last week at a RAIN meeting, and I said, I noticed the Fed in the United States is not going to make any move for 2 years. Canada doesn't want to deviate from that too much. He said, yes, Peter, but the Bank of Canada's definition of deviating from the U.S. could be as much as 2 full percentage points. So just because the Americans are doing nothing for 2 years does not guarantee that we won't. Now, in the meantime, you notice that the discount on the variable rates has shrunk in the past week. The reason is this. I've done some math. Bond rates. You heard that today, for example, the 5-year bond is 1.60. What does that mean? Well, here's what it means. You take the current 5-year rate of, which is about 3.59, subtract that from the 1.60, it equals out to 1.99. That 1.99 is the difference between the bond price and the 5-year fixed price. It's called the spread. The spread is the bank's profitability. Now, they like to keep that profitability spread between 1.75 and 1.95. When it goes below 1.75, they got a raise rate. When it goes above 1.95, they got a lower rate. So now it's at 1.99. So what does that mean? They got a lower rate. So the 5-year rate does move to come down a little bit, but what it really means is banks are making a huge profit there. And on the variable rates, they've been complaining because they're not making any profit. So what do? They lessen the discount on the variable rates and move the market over to fixed rates. Because why? Obviously, they're making a big profit because of the spreads in the bond yields. So watch for further movement in that. New thing I'm going to be doing on the Mortgage Minute here, folks, is I want to answer some of your questions. If you have any questions, feel free to send me an email. We're going to have a contest in the next couple of weeks. I'm going to be giving away my new home study workbook. This is $197. We're going to give away those 5 of these for free to anybody who sends me in an email question. We're going to draw the name out of the hat, and I'll answer your question on the Mortgage Minute next week. That's your Mortgage Minute for Wednesday, August 31st. Hope you guys have a great week. Thanks.